The global meat industry is valued at $1.36 trillion. It now faces a significant transformation over the next 24 months. This shift is characterized by a phenomenon we call the triple squeeze. This includes three main challenges: financial margin compression, regulatory and ESG pressure, and structural labor and input volatility. This isn't merely a temporary downturn but a lasting structural change. Companies aiming to thrive in this landscape must transform their operational strategies. Our report integrates data from various authoritative sources to provide a robust framework for navigating these changes. First, let's explore the financial squeeze. The traditional era of reliable high margins is fading. We're forecasting a drop of 180 to 220 basis points in industry EBITDA margins through 2026. Factors such as elevated feed prices, expected to remain 15 to 20% above the 10-year average, and increased energy costs that have surged by 34% since 2020 contribute to this scenario. Additionally, logistics have transformed, with cold chain shipping costs stabilizing at 75% higher than pre-pandemic levels. Meanwhile, global protein demand is increasing at a CAGR of 1.7%, but its nature is split. There are three key consumer segments. 45% are price sensitive, pushing private label growth despite razor-thin margins. 35% are value driven, willing to pay a premium for better attributes. And 20% are plant curious, substituting meat products with alternatives. Understanding these segments is crucial for companies seeking to adapt their product strategies accordingly. Next, we turn to regulatory and ESG pressures, which are no longer just a public relations exercise. These factors now represent hard financial imperatives. The meat supply chain is responsible for approximately 90% of total emissions. Costs for managing carbon accounting range from $250,000 to $500,000 annually, while implementing essential mitigation strategies can require $2 to $5 million of capital expenditure. Companies failing to embrace ESG compliance might face a staggering sustainability discount on their EBITDA multiples. As for the operational squeeze, labor markets continue to be in crisis. Annual turnover rates in meat processing plants can reach up to 60%. Direct costs of recruitment and training average between $5,000 and $7,000 per employee. Coupled with indirect costs that can triple this expenditure, the total expense of replacing one worker might reach upwards of $21,000. To counter this, efficiency through automation is now a necessity. Robotic systems for processing have shifted payback periods down from over 5 years to under 30 months. Air-driven quality grading technology has also improved accuracy significantly, reducing quality issues and enhancing yield. In terms of strategic pathways, we propose three tailored approaches. Pathway targets top players with vertical integration into alternative proteins while controlling emissions, versus targets top players with vertical integration into alternative proteins while controlling emissions, versus. Pathway B focuses on mid-market leaders utilizing blockchain for transparency, fostering consumer trust and securing premium pricing. Pathway C emphasizes operational excellence, improving asset utilization and harnessing predictive analytics for efficiency gains. In conclusion, the upcoming years will not merely test the meat industry. They will present an opportunity for proactive transformation. Navigating through the triple squeeze requires innovative strategies that view compliance and labor as crucial components of profitability. Companies must ask, how will we strategically define the next era of protein production? For further insights, consider diving into our upcoming reports on the meat supply chain and investment opportunities forecasted for the next phases in the industry. Don't miss out on critical developments that will shape the future of meat production. If you find this information valuable, Please like and subscribe for future updates and visit ESS-Feed for more insight.